Welcome to our roundup of quarterly earnings, ladies and gentlemen. Off the block is a mid-cap IT company, Tata Technologies, where you've seen a slight dip in quarterly net profit, although revenue for the 3 months gone by has improved sequentially as well as year on year. To understand this and a lot more, let's speak to the management of the company. Joining us on the show is Mr. Warren Harris, CEO and MD at mid-sized IT company Tata Technologies. Good morning to you, Mr. Harris, and a very warm welcome. Happy New Year. You've started the block for 2026 on a slight back foot. Would you explain to our viewers and shareholders why was there a dip in quarterly earnings year on year, even though revenue rose?
Yeah, well, Happy New Year to you, and thank you again for the opportunity to catch up. The primary reason for the dip in profits in Q3 was related to the labour law changes that are impacting the entire IT services industry. So we've had to take a one-off provision that will not be repeated in a material way in the future. We also rolled out our salary increments for the year in Q3, and so the growth that we're seeing sequentially and year on year is not translating yet into improvements in the bottom line. But we are very bullish about Q4. The green shoots that you referred to are very real. We've seen that in terms of improvements in our order book, also in terms of deal signings, and we are confident that we can deliver double-digit sequential improvement in top line in Q4, and because of the volume impact, that will translate into margins. We also completed the acquisition of ESTEC in Q3, and we'll have the full contribution of that in Q4. So we're building very strong momentum for a good finish to the year and a great start to FY27.
Wonderful. I'm sure that's heartening to all shareholders who are listening to you, Mr. Harris. Just a couple of niggling points. This downtick in both the net profit margin and OPM, mainly on because of the one-time charge on change in labor laws you've taken. This is temporary. You expect both NPM and OPM to improve in the coming quarter. Am I right?
Absolutely. Our expectations that we will get back to our Q2 margins in Q4, and we'll return next year to the margins that we enjoyed in FY25. So these are one-off issues that are time bound and are unlikely to repeat in the future. So again, we think we've cleaned up the issues associated with our alignment with the change in regulation. We've also in Q3 booked the costs associated with the transaction. So all of that is behind us, and we're looking forward to very strong momentum as we finish the year.
Okay, Mr. Harris. Now let's get behind the tailwind, which is the rise in net sales, which is revenue from operations. A sequential 3.2% uptick and a year-on-year 3.7% uptick. Now, what were the reasons behind this rise, even though it's modest? Is it higher prices or is it newer clients?
It's really new clients, and it's really the return to investment of the manufacturing industry, and specifically the automotive industry. The automotive industry has been impacted by geopolitical events, and also the crisis of confidence in and around electric vehicles. We've seen that play out and until the second half of calendar year 2025. Now the environment is starting to be much more predictable, and as a result, we're seeing that translate into confirmed cycle plans and by association investments, and that's what we're intersecting with. The automotive industry specifically is a product driven business, and business is aligned directly with the investments that our customers are making. So, the green shoots are really coming from that. But we're also seeing strong momentum outside of automotive. Our aerospace business has grown by almost 50% in the first 9 months of this year. We expect that to continue. And one of the things that we were also able to celebrate in Q3 was aerospace and industrial heavy machinery now represent 20% of our services mix. And so we are not only growing, but we're improving the diversity of business and also improving the challenges that we've had traditionally as far as client concentration is concerned.
Mr. Harris, because you sort of traverse the globe meeting customers and potentially new customers, what are they telling you with this gentleman in the hot seat in White House? How has his pronouncements and actions spoiled the narrative for businesses globally in terms of supply chains and all? Or are you uh, are you of a contrary opinion?
Well, I think that when Mr. Trump was elected last year, there were concerns about the policy that he was enacting, particularly as it pertained to tariffs. And one of the things that underpinned the tariff announcement was a number of changes to the rates that he was imposing upon different countries, and that represented uncertainty, and investment is always muted. I think when the markets and the environment is uncertain. What we've seen, I think, is those things settling down towards as we've moved towards the end of the calendar year. And I think that because we're now starting to come to terms with the new normal, our customers are starting to make the decisions that they were expecting to make at the beginning of the year, and that's really what's flowing through to the improvements that have supported our growth and the results that we've presented.
I appreciate the way you put it as the new normal. We have to live with it as long as the pain continues. Might as well accept it as a part of our lives.
I
Let's
think so.
let's move a little further. Now, there is another issue that's grappling specifically uh, with the Indian IT sector is this H1B crisis. How are you impacted? Is this something that you hope will improve for the better, or are you girding yourself up and thinking that even this is a pain point?
Well, we are hoping it gets better, but we are planning that the changes to H1B play out as they have been presented, and I think for us, unlike many of our peer companies here in India, we are not as dependent upon H1Bs as everybody else. We're not an India out company. We very much are committed to growing local teams in the United States, in Europe, in China, in Scandinavia, in Eastern Europe, and so we integrate teams from different parts of the world as part of our proposition. And so, specifically as it pertains to the United States, we're not H1B dependent, and as a result, the impact on us is not nearly as material as it is for some of our peer IT and engineering services companies.
Okay. Now, coming to our original Q&A on the first part, this advent of fresh labor laws, as a percentage of your revenue or a percentage of your profit, whatever you may choose to define as the metric, what was the one-time cost for readjusting your sales to these new labor laws?
Well, what I can say is the one-time cost was material, but I think going forward, the uh, the um, the impact upon performance is likely to be small. We're looking at zero point 0.3 or 0.4% in terms of operating profit going forward, and we think that we've got more than enough operating levers as we continue to commit to delivery excellence to be able to mitigate the impact of that. And so when I talked about our expectations for margins in Q4, that includes the impact of the labor laws, and includes obviously the work that we anticipate that we will need to undertake to ensure that it doesn't drag down our overall profit.
Mr. Harris, globally as well as in India, domestically, we have an issue with fresh hiring, although attrition rates continue to be in the mid teens. What is your outlook on fresh hires into Tata Tech? And would you want to sort of also give us a view on how artificial intelligence is changing your business for the better or worse?
Yeah, I think that's a great point. I think one of the things that we've done in our business in anticipation of the bounce back is that we've protected capacity. We have ensured that as our customers start to invest, we've got the capacity inside of the business to be able to discharge that, and that more than anything else will inform the improvements that we expect to see in margin, because we will see an improvement in top line, and we do not expect to take on the type of expense that will align with that. So in the short term, we do not expect to add headcount, although given our growth expectations for next year, we expect recruitment to start to pick up in the second quarter and continue into the second half of the year. Having said that, and you've made a great point about AI, we will be resource planning against not just FTEs, but also digital workers that will be deployed in terms of AI agents. And so I think you'll see a divergence in the future between top line growth and headcount. We still
Right.
expect to grow headcount, but not at the rate that traditionally we would have had to before the advent of AI.
Fair point. I think we live as we learn. Thank you, Mr. Harris. I know these are troubling times for the IT sector. Here's wishing you the very best that we offer for 2026, and hoping that all NPMs, OPMs, sales and revenue growth come back on stream over the next 2 quarters or so. Have a nice year and all the best to you.
Thank you, and it's always great to catch up. Thank you again.
That, ladies and gentlemen, was Mr. Warren Harris, CEO and MD at Tata Technologies Limited. Thank you for watching.
If you like the video, do like, comment, share and subscribe.